Hello and welcome back to my YouTube channel. In today's video, we're going to see IAS 29, which is financial reporting in hyperinflationary economies. Firstly, we're going to learn on the literature around IAS 29 and all the things we need to know about before applying it in practice. When an entity's functional currency is hyperinflationary, that is, it is the currency of a hyperinflationary economy, the entity's financial statements are to be restated so that all items are presented in the measuring unit current at the reporting date. That is, it adopts the current purchasing power concept of economics. Moreover, when an entity has foreign operations, e.g. a subsidiary or associate or a joint arrangement, whose functional currency is the currency of a hyperinflationary economy, the investee's financial statement needs to be restated before it's being translated and included in the investor's financial statement. So for example, Argentina is a hyperinflationary economy. And let's say that if a company operates in Argentina and the functional currency of that company is in the US dollars, in this case, IAS 29 will not apply because the concept of hyperinflationary economy is tied to the functional currency and not the location of the company being in Argentina. So given that the company's functional currency is in the US dollars, IAS 29 will not apply to that company. All right. So the reporting requirement of IAS 29 is that an entity is required to apply IAS 29 to its financial statement from the beginning of the reporting period in which it identifies the existence of a hyperinflation. There are certain economies that are in hyperinflation. For instance, we have Argentina with an inflation of 161% year on year. We have Lebanon of 212% inflation rate, and we have Venezuela of 283% inflation rate year on year. So there are other economies that are sliding into hyperinflationary situation. So we also need to look out for that and what accounting implication that would mean for us if your company have investments in those companies or entities that are in a hyperinflationary economy. So how do we know if an economy is going or sliding to an hyperinflation or is already in hyperinflation? So according to the accounting standards, it is a matter of judgment to determine when restatement for hyperinflation becomes necessary. So hyperinflation is indicated by the characteristics of an economy, right? So it's a macroeconomic event that we need to look at, which include but not limited to the following conditions. First is that the general population prefers to keep its wealth in non-monetary assets, for instance, PPE or items for PPE, you have inventories and the likes, or they prefer to keep their wealth in a relatively stable foreign currency. For instance, say a country like Nigeria prefer to rather keep their assets or investments in other currencies other than the Naira. That would be a factor to consider, all right? So amount of local currency held are invested immediately to maintain the purchasing power. Another indicator to consider is that the general population regards monetary amount not in terms of the local currency, but in terms of a relatively stable foreign currency. That is, prices may be quoted in a stable currency. For instance, you are in a country A dealing with a customer in the country B. So you prefer to bill the customer in his own currency rather in your own local currency. All right, so that's another indicator of hyperinflation. Then sales and purchases on credit take place at the prices that compensate for the expected. Also, interest rates, wages, and prices are linked to price index. That is where workers are negotiating for wage increase. This increase is usually pegged against the inflation price index. Then the cumulative inflation rate over 3 years is approaching or exceeding 100%. So we have an example to illustrate this. So although the 100% numerical factor is a key factor in identifying hyperinflation, it is not the only factor that we should consider. All right, so applying all these factors could result in a country being considered hyperinflationary when its 3-year cumulative inflation rate is, for example, say only just 80%. All right. So how do we measure inflation rate? The first is looking at the appropriate price index. So for most countries, there are two main indexes that are generally used in measuring the inflation rate. The first is your consumer price index, which is your CPI, or a producer or wholesale price index, the PPI or WPI. So the CPI, the Consumer Price Index, measures the change in the cost of fixed basket of products and services consumed by a typical household, right? So the price of things you get in the market forms under the CPI measure. Generally, this includes housing costs, electricity, your food, your transportation, etc. Then the accounting standards require the use of a general price index that reflects the changes in the general purchasing power. So the CPI is most appropriate to use in this situation. Then for a cumulative inflation rate, like we said that if it's on the high side, it's an indicator for hyperinflation. So IAS 29 refers to a cumulative inflation rate, but is silent on how the calculation of such rates should be done, either being simple basis or compounded basis. So let's see an example of how to determine cumulative inflation rate using the simple basis versus the compounded basis. So the inflation rate in 3 consecutive years is 20%, 30%, and 40% respectively. So the cumulative rate on a simple basis is 90%. That is the sum of 20, 30 plus 40, right? But if it's on a compounded basis, it is 118%. So we're going to see how to do this. So we have our rates in here, 2017, 2018, 2019, 3 years basis, and we have the inflation rate of 20%, 30%, and 40%. So we need to convert the percentages to rates, that is 1.2, 1.3, and 1.4 respectively. So for a price index, we need to start with the base index, which is always 100. So at the start of year 1, we have our base index as 100. So at the end of year 1, year 2, year 3, we're going to calculate what this price index will be given the inflation rate. With the start of 100, we need to calculate the price index for end of year 1, which is simply the base amount multiplied by 1.2. All right, goes to the base multiplied by the 1.2. All right, so we have 120 as the price index for end of year 1. Then for the end of year 2, we apply the 1.3 rate on 120. So 120 multiplied by 1.3. And at the end of year 3, we apply the 150 on 1.4. All right. So we calculated the price index for the 3 consecutive years to be 120, 156, and 218. So now to calculate the cumulative inflation rate is simply to take the price index at the end of year 3 less the base price index divided by 100 equals to open bracket 218 minus 100 base index divided by 100. So we have 118%, like we said initially, that for a compounded basis over a 3-year period for these rates, the cumulative inflation rate is 118% year on year. So with this, you can assess. So with this, you can assess the indicator for a hyperinflation for the economy if it's tending towards a hyperinflationary economy. Or alternatively, we can use the inflation rate to compute the cumulative inflation rate by using this formula, which is equals to 1 plus 20% multiplied by 1 plus 30% multiplied by 1 plus 40% less 1. So we'll get the same 118%. So equals to 3 brackets. 1 plus 20%, close my bracket, multiplied by, open my bracket again, 1 plus 30%, close my bracket, multiply by, open my bracket again, 1 plus 40%, close my brackets, and the other one, then less or 1, close my bracket. So we also have 118%. Right, so that's our cumulative inflation rate. So the next video will be on steps to restate a financial statement for hyperinflation. So thank you for watching and see you in my next video. Bye.